Welcome to this explainer for the AI investment memo. Today, we're sizing up the unquestioned heavyweight champion of animal health, Zoetis. For years, this company was basically viewed as a flawless compounding machine, a premier healthcare stock you could just buy, tuck away, and practically forget about. But lately, the reigning champ has hit a serious patch of friction. So we're going to put the Zoetis investment thesis under a highly skeptical microscope today to answer one absolutely crucial question. Is this high-quality business still a truly exceptional investment right now? Let's dive in and find out.
To really wrap our heads around the sheer scale of this company, just look at that revenue number, nearly $9.5 billion in 2025. Zoetis is massive. They are armed with a sprawling global portfolio, deeply entrenched relationships with vets all over the world, and historically unusually attractive profit margins. But following a major stumble in recent quarters, Wall Street is asking a really vital question. Is their current slowdown just, a temporary speed bump on a long road of growth, or are we actually starting to see a fundamental crack in their foundation?
To figure out where they are today, we kind of have to look at how they got here. Originally spun off from Pfizer, Zoetis started out with this incredible infrastructure and scale. But the real magic happened when management strategically pivoted the company. As you can see by this breakdown, they completely transformed the old Zoetis, which was super reliant on livestock and farm animals, into the new Zoetis. This new iteration is dominated by high-margin, premium therapeutics for companion animals. Think the dogs and cats in our homes. They created best-in-class treatments for things like allergies and parasites, which drove massive growth. But that very successful pivot to premium, it also brought a whole new set of sky-high expectations.
Okay, moving into Section 1, the thesis stress test. Let's actually test this bullish narrative against reality.
On the surface, early 2026 looked relatively stable. Management reported top-line revenue growth of 3%, but honestly, that number was highly misleading. It was flattered by a fiscal year alignment. Essentially, it was an accounting shift that dumped about $100 million of international sales into the quarter. If you strip out that calendar noise and look at the actual organic operational growth right next to it, they were actually down 5%. That sharp directional drop is a massive reality check for a company that has historically been priced for absolute perfection.
And here is the most concerning crack in that premium foundation, a steep 11% drop in U.S. companion animal sales during that exact same quarter. Remember those ultra-high-margin dog and cat therapeutics that basically built the new Zoetis? Yeah, a double-digit decline here proves they did not cleanly pass our stress test. Now, the company didn't fail catastrophically by any means, but for a stock trading at such a premium multiple, an organic drop like that is literally impossible to ignore.
So what exactly caused that sudden drop? Well, management cited a triple threat of pressures attacking their moat. First up, pet owners are just getting way more price sensitive, which translates directly to lower overall traffic at vet clinics. Second, Zoetis is suddenly facing fierce new competition in their highly profitable dermatology and parasiticide categories. And third, generic versions of their older legacy products are actively eating away at market share. Any one of these is tough to navigate on its own, but all happening simultaneously, they severely attack the company's ability to maintain that premium pricing power.
And this vulnerability feeds into a much larger risk, because Zoetis is incredibly reliant on its biggest winners. Just look at this concentration. A staggering 57% of their total revenue comes from just their top 10 product lines. Why does that matter to us? Well, it leaves them highly exposed. The exact categories where competition is heating up the most right now, like dermatology and parasiticides, are the exact same categories generating the lion's share of their profits. It's like having all your eggs in the one basket that's currently under attack. It's a structural vulnerability that honestly just wasn't there a few years ago.
All right, Section 2, regulatory and safety overhangs. Let's take a look at the external challenges piling up.
Because beyond pure operating execution, these external challenges are really compounding their stress. We are seeing rising regulatory heat, specifically surrounding Librela, that's their flagship osteoarthritis pain medication for dogs. Check out this timeline. It started in March 2024 with an EU antitrust probe over competitive conduct. Then, fast forward to December, the FDA issues a Dear Veterinarian safety letter regarding adverse events. And by February 2025, that forced actual labeling changes. Look, none of these issues are going to break the company on their own. But together, they materially raise the burden of proof. It means management is out there fighting external fires at the exact moment they need to be defending their core market share against new competitors.
Let's transition to Section 3, Management and Capital Allocation. How exactly did leadership handle these headwinds?
Well, in 2025, Zoetis repurchased a massive $3.2 billion of its own stock.
Now, to be fair, buying back stock isn't inherently a bad thing, but the timing here really raises some eyebrows. Management aggressively used their balance sheet capacity. They actually took on new debt to fund these massive buybacks right before the operating reset we just talked about. They effectively burned through their financial flexibility precisely when their end markets were softening.
And this maneuver led to some pretty deep skepticism from the buy side. As this quote perfectly captures, debt-supported buybacks just ahead of a reset should reduce, not increase trust. Usually, exceptional capital allocators earn the benefit of the doubt by keeping some dry powder, preserving flexibility when market visibility gets cloudy. Pushing the buyback pedal to the floor with new debt right before sales organically contract, it really forces us to ask, was management being disciplined here, or were they just being complacent about the macro environment?
And this brilliantly illustrates how the investment math has fundamentally shifted. Historically, the base case for Zoetis was practically a given: safe, lucrative growth driven by premiumization. But today, as competitive and economic pressures mount, the base case now means slower growth and much tighter margins. Don't get me wrong, the business is absolutely still going to grow. But the required entry price for this investment has materially changed. Investors can no longer just assume elite compounding returns without absolutely perfect execution from the company.
Which brings us to Section 4, the final investment verdict, the definitive conclusion.
So what's the definitive takeaway of this entire explainer? Zoetis is absolutely still a good, high-quality company, no doubt about it. But under a skeptical, high-bar framework, it just doesn't clear the bar for a great investment right now. For this stock to re-enter the investable set, we need to see a few specific conditions met. First, a clean, actual re-acceleration in the U.S. companion animal market, no accounting tricks. Second, their pain medications have to show sustainable growth that is totally free of regulatory drama. And third, the stock's valuation actually needs to compress to reflect the fact that they are currently in a prove-it phase. Until those things happen, fresh capital does not need to be committed.
I want to leave you with this provocative question to chew on as we wrap up. Are we paying for past perfection or future resilience? Zoetis had an absolutely incredible decade, for sure. But the market they're operating in today is more cyclical, it's way more competitive, and it is far less forgiving than it used to be. It's a powerful reminder that in the world of premium compounders, a great company only makes a great investment if the price accurately reflects the road ahead, not just the triumphs of the past.